Thanks, Harry. Good morning, everyone. My name is Deepali, and I'll be providing you with a review and outlook of the coking coal market. Here's our standard disclaimer. The agenda for today. So I'll begin with a brief introduction of Metal Bulletin. Then I'll be talking about a review of the coking coal market's performance in 2017, followed by some of the factors that we need to watch out for in terms of impact on prices in 2018. I'll also be talking a bit about the methodology that Metal Bulletin follows when it comes to calculating its 4 daily coking coal indices. And finally, I'll touch a bit on our corporate structure and compliance procedures to ensure that our prices are objective and following the best practices. So about Metal Bulletin, Metal Bulletin is an over 100-year-old price reporting agency. We are owned by Euromoney, which is a FTSE 250 company. It's listed on the London Stock Exchange. Across the Metal Bulletin Group, we publish some 2,000 prices, including both assessments as well as indices. We are headquartered in London and present in all the major cities of the world. So how are Metal Bulletin prices used? Metal Bulletin prices are used in physical contracts. The prices are industry standard benchmarks. They are the basis of settlements for several derivatives listed on the exchanges. And a lot of our prices are also used as reference by the market. So coming to coking coal, I believe that last year there were broadly 3 factors which sort of defined the performance of the seaborne coking coal market. The first, of course, was Cyclone Debbie, which hit Queensland in the month of March and wiped off 10 million tons of seaborne supply. The second was China's focus on environmental protection, which resulted in steel prices hitting multi-year high last year, and sort of the impact of that trickled down the entire ferrous value chain. And finally, there was again a lot of volatility in the seaborne coking coal prices, something that's increasingly becoming the norm rather than the exception when it comes to coking coal. So here's a snapshot of the Metal Bulletin Premium Hard Coking Coal Index FOB Australia basis, starting from 2016 right until the end of 2017. And as I just mentioned, the market has been fairly volatile, as this graph sort of demonstrates. Last year, of course, Cyclone Debbie was the major sort of influence on prices, resulting in FOB Australia levels hitting $300 per ton. But soon after that, we saw, a very sharp correction in the market as well, with the rail transport sort of coming back online and connecting the mines to the port in Queensland quicker than was anticipated. However, towards the end of the year, the seaborne prices on a FOB Australia basis started to move up again. And that was, again, on the back of mining disruption at some of the Australian producers, as well as a buildup of vessel queue at the main coal exporting hub of DBCT. So the impact of Debbie and the supply disruption that caused in the market and resulting higher seaborne coking coal prices is I think fairly well understood by by everyone. However, there was also another sort of factor that supported the seaborne coking coal prices last year, and that was the developments that we saw in the domestic Chinese market with their focus on safety of mining procedures as well as protection of the environment. So the graph on the screen here is basically the domestic China coking coal prices on a yuan per ton basis and delivered to Tangshan. These are quarterly prices, and these are the average of a wide range of grades which are traded in the domestic Chinese market. So you'd expect to see a top-tier coal in the domestic market to actually trade much higher than what the levels here demonstrate. But if you just look in terms of the trajectory, similar to the trajectory that we saw in the seaborne market since the second half of 2016, the domestic Chinese coking coal prices also saw a sharp increase in the second half of 2016. And throughout 2017, they maintained that level. And those levels were maintained because of a bunch of factors. Those levels were maintained because there were safety inspections throughout the third quarter ahead of the once-in-a-decade meeting of the Chinese Politburo, which took place in October. So the miners sort of introduced some voluntary production cuts. There were also some mining accidents which took place in the Shaanxi province, which resulted in, again, voluntary production cuts as well as tightness in the domestic supply. And besides that, there were sort of interim factors which kept the domestic prices supported, and these included the longer wait time for custom clearance for imported materials that we saw. So I think the usual wait time for the imported materials to get customs clearance in China is about 20 days. And that sort of extended to about 45 days last year. And of course, there were some interim jitters with Mongolian supply into China as well. And why is this important? Why are we looking at the domestic Chinese coking coal price performance? It's important to look at that because China buys seaborne coal for two reasons. It buys seaborne coal for the quality, so the premium low vols are bought for the quality, but it also buys seaborne coal when the price advantage is there, when it makes sense for it to buy seaborne coal over its domestic cargoes. And the fact that the domestic prices in China sort of stayed at elevated levels last year just underlined why Chinese imports of coking coal actually went up in 2017. The other crucial factor that sort of underlined the performance of steelmaking raw materials in 2017, and probably the more crucial factor, was the performance of the steel sector. Now, steel prices, these are Metal Bulletin's daily Eastern China rebar prices on a yuan per ton basis, and you can see the trajectory, again, since the beginning of 2016 right up to 2017 December. And you can see here that prices, steel prices in China hit a multi-year high last year. And again, those were based on two key factors. The first factor, of course, was the supply-side reforms that China introduced as part of its 13th five-year plan. China already met 76% of its targeted capacity output in 2017 itself, and this is 76% of its targeted capacity cut output for a five-year period starting in 2016. That was one. The second factor, of course, was the restrictions on blast furnace operations, and probably a more important factor that were rolled out in November. And that provided the supply side sort of push to prices. On the demand side, again, the Chinese steel market performance was pretty good. China's steel consumption grew by 7% on a year-on-year basis to about 725 million tons last year. And both supply and demand side factors sort of coalesced in 2017 to result in higher steel prices, which meant higher steel margins, and which meant that across the steel value chain, the prices remained supported. So what did that mean for the seaborne coking coal prices? The graph here shows the yellow line is the 2017 Metal Bulletin CFR China Premium Hard Coking Coal Index. And the blue line is the 2016 CFR China Premium Hard Coking Coal Index. And as you can see here, that in the second half of 2016, of course, the prices saw a massive rally on the back of supply cuts in China, as well as the weather situation. However, on average, the prices remained higher in 2017 compared with 2016 because of first, the disruption to Australian supply, but also because of the domestic Chinese market prices for coking coal staying at an elevated level, and the robust steel mills margins, which meant that across the steel value chain, the prices sort of remained higher, and the appetite for higher raw materials prices also remained intact. Now, looking at 2018, again, I believe that there'll be three factors that the market sort of needs to watch out for. The first, of course, is Australian supply. That will remain crucial. We are still in the cyclone season, and the buyers are still a bit jittery about potential supply disruptions, but that is very hard to predict anyway. I think there'll also be some focus on among the buyers to look at alternative options of supply, and that is something we already started seeing last year when Cyclone Debbie hit the market. These alternative options, and I don't suggest that they can replace the Australian quality or the quantity of supply, but definitely something for the buyers to look out for in terms of diversifying or spreading out their risks. The second factor I feel will be crucial to watch out for in 2018 would again be the performance of the Chinese steel sector. So in 2017, as I mentioned, China's environmental push meant that production restrictions were enforced with full force, and China has already met more than half of its targeted capacity cut over a 5-year period from 2016 to 2020, last year itself. So it would be interesting to see the rigor with which China's focus on environmental protection is rolled out this year, and how that sort of plays up with the steel prices and in turn the steel mills margins. And finally, the developments that the coking coal market has seen since the second half of 2016, especially with the volatility, with the supply disruptions, that's definitely put the focus on the indices that are published by price reporting agencies such as Metal Bulletin, and the methodology that we are following to publish these indices and provide the market with reference prices, I believe will be a key focus for the market in 2018. Just a point on the supply situation in 2018. So last year, we saw that supply of coking coal from United States actually grew by about 10 million tons on a year-on-year basis, and this was possibly the first time in 5 years that year-on-year exports of met coal from the US were higher. However, it remains to be seen whether, as a source of alternative supply, the United States can continue ramping up its exports. And the reason I say that is, since the second half of 2016, the rise in seaborne coking coal prices have been a result of temporary situations. So it's been a result of, for example, Cyclone Debbie. But it remains to be seen whether there are any structural changes which have actually happened in the market, which can, propel producers, such as producers in the United States, to continue ramping up their production and take advantage of the higher prices. The second factor, as I mentioned, of course, would be the performance of the steel sector in China. And as I said, the strong steel mills margins just provided the buyers with a cushion to accept the higher coking coal prices as well, aside from the other, developments in the domestic coking coal market. So far in 2018, steel prices in China have seen a bit of softening, and these are again Eastern China rebar prices assessed by Metal Bulletin. In the month of January, we saw prices softening, and those were a function of the reduction in construction sector activity during the winter months. In recent weeks, of course, prices have stabilized slightly, and I guess that's got to do with anticipation of demand sort of improving in the spring months, as well as some talks in the market of blast furnace restrictions actually being extended beyond March 15. So the provincial government of the Hebei province in China has officially said that a decision with regard to the blast furnace restrictions has not been taken, but from what we've heard from the Chinese market participants, it is highly likely that those restrictions will be applied, but probably not in the form of a blanket restriction, but interim restrictions depending on the air quality. So why are we, why is it important to look at the trajectory of coking coal prices and the development in the Chinese market, the methodology that price reporting agencies such as Metal Bulletin is following? It's important to look at that because among the steel-making raw materials, coking coal over the past few years has been the most volatile. And that puts the focus, as I said earlier, on what PRAs are doing in terms of providing the market with objective prices. I can talk about Metal Bulletin. We publish 4 daily coking coal indices, tracking FOB Australia and CFR China prices for premium hard and hard coking coal. And our methodology is based on 3 sort of principles. First, it's a transaction-based methodology, which means that the trades which happen in the market have the most influence on the index of the day, rather than a journalist's assessment. The second, we have a 2 sub-indices structure, which means both sides of the market, the buy side and the sell side, has an equal weighting in the final index calculation. And finally, we have robust fallback procedures, which are also published as part of our methodology to ensure that given whatever data set, we are still able to publish the indices with a published methodology. Quickly on the methodology itself, so there are 2 ways we gather the data from the market. There's the active way and the passive way. The active way is journalists or reporters, price reporters, reaching out to the market to collect information on trades. The passive way is, the data submission agreements we have with some stakeholders, whereby they provide us with information on the trades that they've concluded, and also trades done on online platforms such as Global Coal. The data itself is segregated into transaction and non-transaction, and I'll come back to how we assign tonnage weighting to it. So once we've gathered the data, it's split into buy side and sell side. Each transaction data that Metal Bulletin collects, either through the passive way or active way, gets the maximum tonnage weighting in the calculation of the index, whereas every non-transaction data, if it is used, then that gets the minimum tonnage weighting in the calculation of the index. And again, I'd like to repeat here, the idea is to make sure that the index of the day is tracking transactions and is not tracking the sentiment or the opinion of somebody in the market. Of course, you'll have days when there are no transactions in the market, but there are clear indicators that the market has moved. For example, there could be days of no trades, but bids going up or offers going down. So we will use such data as well in the index calculation, but it will be assigned the minimum tonnage weighting so that its influence on the final index is checked. So just coming back to the methodology, so we split the data into buy side and sell side. Each data point is normalized based on the relativity or the normalization coefficient that we calculate and publish every month. And a straight average of the two sub-indices of the buy side and the sell side index gives us a preliminary index figure. Once we have the preliminary index figure, the model sort of looks for outliers. So these would be data points which are plus minus 4% away from that preliminary index figure. The model will remove those outliers, recalculate the buy side and the sell side indices again, and then a straight average of the two will result in the final index. And as I said, we also have very robust fallback procedures. Again, I'd like to iterate that actual transactions have the greatest effect on the final indices. However, in the very unlikely scenario where we consider that a data set that we've collected on a day from the market is not suitably robust, then we follow these fallback procedures, which are also published and available to you all in order to make sure that we are still able to provide the market with an index for the day. And that was on the methodology. There are, of course, other steps that the company has taken overall to sort of make sure that its pricing is robust. These include aligning all our prices with IOSCO principles and making sure that Metal Bulletin employees adhere to a code of conduct, which sort of prescribes the best practices when it comes to price discovery. We've also completed our first benchmark assurance review last year, and some of our prices were selected for that review process, and the details of it are available on the link, and this presentation will be made available to you as well. One other thing that I'd like to highlight here is we've also invested in online digital platforms where the data that we collect from the market can be stored securely, and if required, it can also be audited, and the data is stored confidentially, securely, and in an auditable format. So the company is putting a lot of emphasis on making sure that we are providing objective prices with our methodology, but also investing in processes to make sure that we are compliant with the best practices in the market. That's it from me. Thank you for your attention, and if you have any questions, then please let me know.